The market is currently closed, and SoFi Technologies Inc. (SoFi) finished its last session on Tuesday, December 2, 2025, with a closing price of $29.68. This is the figure that sets the stage for today's analysis, but the real story is not the closing bell, it's the dramatic 118% surge over the last 6 months that has completely repriced this stock. That move is what demands our attention, because the expectation among retail traders is that this parabolic rise is the start of a clear, unimpeded path to becoming a top-tier financial institution, a bank of the future that simply cannot be stopped. The reality, however, is a deeper and more nuanced financial structure, one that is built on 3 distinct pillars: lending, the technology platform, and financial services, which are creating a powerful flywheel effect that the market is only just beginning to truly appreciate. While the common narrative focuses on their student loan refinancing business as the primary catalyst, the unexpected and more powerful insight is that the financial services and technology platform segments are now consistently driving higher margin, capital-light revenue, successfully shifting the company's dependency away from its balance sheet-heavy lending operations. This strategic pivot is what separates the current price action from the speculative fervor of its SPAC roots. The immediate stock movement has been dictated heavily by the reaction to the most recent financial disclosure, where SoFi delivered its 4th consecutive quarter of GAAP net income in Q3 2025. This wasn't just a beat, it was a resounding confirmation of the management team's long-term plan to achieve sustainable profitability, something that was an absolute pipe dream for years following its public debut. Revenue surged by 38% year-over-year to a record $950 million, comfortably exceeding analyst expectations. This performance was not driven by a single area, but by the rapid expansion of its non-lending businesses, which for the first time collectively generated over $500 million in quarterly revenue, and now represent over 50% of the company's total adjusted net revenue. This is a critical factor that many generalist investors miss. SoFi is rapidly transforming from a high-growth lending company to a diversified financial technology platform. The market initially expected a slow, grinding crawl toward profitability, heavily dependent on the unpredictable student loan market. The reality is that the financial services segment, which includes SoFi Checking and Savings and SoFi Invest, saw its net revenue more than double from just a few quarters prior, fueled by a record growth in members and products. This unexpected diversification has resulted in management raising its full-year guidance for 2025, which added jet fuel to the stock's run towards the high end of its 52-week range of $8.60 to $32.73. High trading volumes, often reaching over 60 million shares daily, coupled with significant institutional buying, have underscored this fundamental re-rating. However, no growth story, particularly in the fintech space, comes without its friction, and SoFi is no stranger to the attention of short sellers. The short-selling community has been active, and it is a factor that any serious investor needs to monitor closely. Latest data from the middle of November 2025 showed short interest standing at over 116 million shares, which represents approximately 9.8% of the public float. This level is relatively high for a company that has recently achieved profitability, indicating a persistent skeptical thesis. Short sellers, including some well-known financial firms, are primarily focused on the quality of the loan book and the impact of a potential recession or credit cycle turn. Their thesis hinges on the belief that SoFi's rapid loan growth, particularly in personal loans, which have reached an all-time high of $7.5 billion in originations, could lead to unforeseen credit losses if the macroeconomic environment sours. They point to the high price-to-earnings ratio, currently sitting in the low to mid-50s, as a sign of overvaluation that justifies their short position, arguing that the pricing has simply gotten ahead of the realistic timeline for earnings growth. The borrow rates, while not excessively punitive, have shown some modest fluctuation around the 0.25 to 0.29% mark in late November, suggesting a mild but consistent cost for taking a bearish position. Days to cover, a measure of how long it would take for short sellers to buy back all borrowed shares, sits around 2.58 days, which is not high enough to indicate an imminent violent short squeeze, but it provides a foundation of trapped buyers should an unexpected catalyst occur. For retail investors, the actionable insight here is to monitor the fail-to-deliver data and institutional filings. If firms with large short positions suddenly start covering, or if the days-to-cover metric spikes above 5, it signals a significant shift in the short seller pressure. Remember, short sellers are sophisticated, but they are driven by a singular directional bet, and their motives must be balanced against the company's proven ability to execute its plan. The company's core business is to serve as a comprehensive, digital-first financial one-stop shop for its members, a strategy that is predicated on cross-selling. The key is the technology platform, powered by Galileo and Technisys. Galileo is the processing core for many other fintech companies, providing accounts, payments, and digital banking infrastructure. This is essentially a high-margin, business-to-business software component that generates predictable fee revenue, insulating SoFi from the direct credit risk of its own lending operations. The recent launch of products, including blockchain-powered remittances and in-app cryptocurrency trading, has bolstered the financial services segment, significantly improving the revenue per product metric. The general belief was that SoFi would perpetually struggle to monetize its non-lending products. But the reality is that the financial services segment alone has grown to become an annualized billion-dollar revenue stream. This platform model, lending to acquire high-quality members, then cross-selling high-margin, low-capital-intensive products, is the engine of the entire growth thesis. The student loan segment, while a smaller piece of the puzzle now, is also seeing a rebound. With the continued uncertainty and political wrangling around federal student loan forbearance and forgiveness, a growing number of borrowers are seeking clarity and better rates through private refinancing, a trend that plays directly into SoFi's wheelhouse. Originations in student loans increased significantly in the last reported quarter, a clear indication that a key part of their legacy business is re-accelerating, adding another layer of revenue diversification. Looking forward, the future outlook for SoFi is framed by a clear tension between the expectations of continued hypergrowth and the reality of macroeconomic headwinds. The major catalyst that investors are anticipating is the further expansion of the loan platform business, which involves originating loans on behalf of third parties. This allows SoFi to generate high-margin, fee-based revenue from lending without putting the asset on its own balance sheet. A brilliant move that essentially turns its lending expertise into a recurring technology and service fee. A recently announced $2 billion agreement for this platform highlights the growing demand for this capital-light revenue stream, and the expectation is for more of these deals to follow. The risks, of course, remain tied to credit quality and regulatory scrutiny. While the company's credit performance has been strong, with annualized charge-off rates for personal loans reaching their lowest level in 2 years, a sudden spike in unemployment or a rapid deceleration in consumer spending could quickly deteriorate the loan book and force an increase in provisions for credit losses. Furthermore, the regulatory environment for digital-first banks is constantly evolving, and unexpected policy shifts could impose new compliance costs or capital requirements, which could temper growth. The conversation around this stock, both on platforms like Reddit and in professional analysis, is constantly asking about the sustainability of this growth. This is where the expectation versus reality framework provides the most value. The expectation is that SoFi stock will simply climb in a straight line as it continues to execute its financial technology plan.